So for those that don't know, the unemployment rate, it gets updated every month, and for a while now, economists and sort of economic thinkers and business people have been sort of generically predicting a recession, like, oh, recession's going to come at some point, in the next year or two, right? But it's been a recession's going to come in the next year or two for about a year or two now, right? And so we're getting to the point where the people that were predicting recession are definitively wrong, but there's still a strong contingent of people who are saying that the conditions for a recession just seems to make sense that a recession is going to happen at some point. Like if we look at the classic 10-year minus 2-year yield curve. So this is the yield curve that people mention. 10 minus 2 years is inverted. I think the more my professor once described that that I think it was the 10-year minus the 3 month, not the 30-year minus the 3 month. The 10-year minus the 3 month is the more sort of like academic way, but essentially that's all to say that the yield curve is inverted, right? And this is as you can see, a very historically accurate marker for a recession. Inflation's still pretty high. Consumer spending seems to be getting curtailed to some degree. Obviously, people are also talking about a very tight labor market. But with this last jobs report, this January 2023 jobs report, it blew everyone out of the water in terms of their predictions, right? So increase of 517,000 jobs in January, crushing the estimates, and unemployment rate has hit a 53-year low. So the unemployment rate today is lower than it ever was in the last 53 years, lower than it was during the Trump presidency, during the Obama presidency, during the Clinton presidency, during all that time. And 500,000 jobs is a ton of jobs to be added, especially when the unemployment rate was already 3.5%, right? A lot of people have also been saying we're in full employment, but it seems like, well, damn, I mean, if we're in full employment, like, where the fuck? 500,000 jobs just got added. So where really is full employment in our economy? And people have also been talking about, obviously, the tight labor market, that a lot of people resigned or quit, and, employers are struggling to find jobs to find employees. And so I figured we could read this article. The U.S. labor market was stronger than we thought, and then we'll read another article after that. This one's by Joseph Politano from Apricidas Economics, which I always, literally 100% of the time, don't pronounce right. So updated data shows strong employment and payroll gains alongside decelerations in wage growth. All right, updated data shows strong employment and payroll gains alongside decelerations in wage growth. All right, can inflation come down without a recessionary increase in the unemployment rate? That's the critical question facing today's U.S. economy. On balance, the large batch of updated labor market data published in the last week makes the soft landing outcome where inflation dissipates without a recession more likely. Jobs data remained extremely strong, with significant upward revisions to both employment and payrolls. Those revisions also erased perceived jobs losses in select key sectors that serve as leading indicators for economic activity. The unemployment rate also sank to its lowest level since 1969, and prime age employment rates remain just 0.4% below pre-pandemic peaks. Meanwhile, wage growth continued to decelerate, with private industry wages growing at 5.1% over the year ending in Q4, according to the more comprehensive Employment Cost Index, and average hourly earnings for private sector workers growing 4.4% over the year ending in January 23, according to payrolls data. This deceleration remains particularly stark in low-paying sectors like retail, trade, and leisure hospitality. U.S. gross labor income growth. Gross labor income picked up in January payrolls data. That's caused growth in gross labor income, the aggregate sum of workers' wages and salaries, to substantially decelerate over the last quarter. Though the growth remains above pre-pandemic rates, and the non-farm payrolls numbers has surged thanks to an unusually good January. Still, the data released this week shifts our perspective of the labor market in a way that makes a soft landing more likely. More of the growth in gross labor income is coming from net job gains, and less of it now coming from nominal wage growth. And unemployment did not have to rise to achieve the rebalancing we've seen so far in the labor market. However, that also means the Fed's job in fighting inflation is not yet over, and on the margins, they are likely to perceive the resilience in job growth as indicating the U.S. economy can handle higher interest rates than previously believed. The stronger labor market. Yesterday's jobs report shows the U.S. adding more than 500,000 jobs in January, rapidly exceeding consensus forecasts and notching the largest monthly increase in non-farm payrolls since July. The underlying month-to-month strength probably isn't quite as dramatic as headline numbers suggest. Employment growth was relatively weak, and a lot of the payroll's strength seems to stem from how shifts in the seasonal patterns are interacting with seasonal adjustment calculations derived from older data. But it was revisions to growth over the last year that represented the largest sign of strength in the labor market, the shape of job growth. There are now more jobs than pre-pandemic, and most sectors have fully recovered. All right, then. I guess this is change since January 2020, millions of jobs. So this is sort of a cumulative figure, I guess, and looks like they're all pretty much, it's exactly right. They're all pretty much recovered, except for what is this, leisure, hospitality, and government, I guess, surprisingly enough. Okay, that's interesting. December payrolls were revised up by 813,000 thanks to the incorporation of comprehensive annual benchmark revisions to BLS data. Silicon, another $2 Australian. So is Powell the best central banker? I don't know if he's the best central banker. I mean, certainly, he's probably got a decent head on his shoulders. Obviously, he's been criticized for not raising interest rates enough, early enough, and then he was also criticized for the sort of extension of the transitory narrative, and then he's been criticized by progressives for a number of issues. But I mean, the reality is I think he's doing probably a fine job. I mean, he's not that bad. December payrolls were revised up by 813,000 thanks to the incorporation of comprehensive annual benchmark revisions to BLS data, meaning the U.S. has added nearly 5 million jobs over the last 12 months. Essentially, all major industry groups have seen a full employment recovery since the start of the pandemic, except leisure and hospitality and government, which includes public schools. And those industries have mostly seen job declines as a result of higher-paying industries poaching their workers. Even healthcare services employment, one of the industries most impacted by COVID-19, has now more than fully recovered. Labor Market Mystery Hour. Revisions have changed our understanding of the labor market. And this is the revised and unrevised estimate, I suppose, here, and I guess you can see some marginal differences. We also received updates to the population estimates that are used to weigh results from the household survey to determine levels and rates of unemployment and employment. The number of employed Americans increased by 810,000 thanks to these population controls. BLS doesn't revise old household survey data with new population benchmarks, hits the large jump in January. Meaning we can now officially confirm that both non-farm payrolls and overall employment exceed pre-pandemic levels. Unfortunately, this jobs report did not provide easy answers to the lingering discrepancy between employment data from the household survey and non-farm payrolls data from the establishment survey. Since March 2022, the payrolls data has been running hotter than employment data, and since both series were revised upward by 800,000, the gap still largely persists. It's possible this discrepancy will only be corrected at the benchmark revision. The Business Employment Dynamics report, which is based on some comprehensive underlying data that goes onto the payrolls benchmark, showed a net job loss of 300,000 in Q2 2022. That stands in stark contrast with the 1.2 million jobs gained reported in payrolls data over the same period. Still, the discrepancy feels less pressing because both surveys now agree that employment is rising broadly. The building cycle. Residential construction employment is even stronger looking with revisions. The benchmark revisions also reshaped our understanding of some of the key leading indicators for the labor market, sectors that tend to lead employment dynamics elsewhere in the economy or are otherwise more sensitive to overall economic conditions. Residential building employment, which before looked to be holding up moderately well despite higher mortgage rates, now looks even stronger. Total fulfillment. Warehousing employment growth has stalled this year. Employment in warehousing and storage is also significantly larger and holding up better than previously reported. The number of jobs in the industry has practically doubled since 2017 as U.S. e-commerce spending soared and was turbocharged by the pandemic, although the slowdown in 2022 has been palpable. Truck transportation, another key goods-related sector, has seen employment hit another record high this month. Tech session. Employment is stalling in key digital tech sectors. All employees, software publishers, computer infrastructure, media streaming distribution services, web search portals, and other information services. I don't know. I mean, it doesn't look like these are stalling that much. I guess this one's stagnating at the very, very end here, but I mean, the trend seems, I mean, the trends on the top two are sort of undeniable at the very least, and I guess web search portals is sort of meteorically rising. Yesterday's jobs report also saw a reclassification of many employment categories to reflect updated industry categories. About 10% of jobs were reclassified into different industries, with most of the shifts designed to better reflect the realities of employment in the retail, trade, and information sectors amidst the rise of e-commerce and digital services. Critically, these updates allow us to take a closer look at the recent downturn in the U.S. tech industry at a level of detail that was not possible before. So far, employment has stalled in many key tech sectors, especially the fastest growing industries of software publishing and computing infrastructure. But so far, overall job losses have been minimal. The bigger deal seems to be a stagnation or decline in compensation, including normal wages, stock options, and other bonuses. Darn software engineers, their stock options are drying up. My goodness. Combined, it means that many of the sectors that had demand pulled forward during the early pandemic, tech, transportation, warehousing, home building, manufacturing, and more, are holding up better than we previously thought, and outside these sectors, job growth and employment gains remain strong. All right, moving on to unemployment. And underemployment. Looking at underemployment gives a better picture of the labor market. Unemployment in yellow, part-time for economic reasons in green, and not in the labor force but want a job now in red. And pretty much all of these are, it appears that all of these are below pre-pandemic levels, if I am reading this right. Labor market strength has now driven unemployment to the lowest level since 1969. Even if you take an expanded view, including those marginally attached to the labor force and those working part-time who want to work full-time, underemployment is at the lowest level for as long as microdata is available. Wow, that's interesting. So yeah, not only, if you look at this closely, not only pre-pandemic, but for as long as this data is available, it's the lowest it's ever been. Well below full employment. Lowest possible estimates of full employment. Prime age 25 to 54 employment to population ratio. However, the broadest and most important measure of employment strength is still below pre-pandemic levels. The share of working age adults with a job is still slightly below the 80.6% notch just before COVID, significantly below the 81.9% achieved in the late 1990s, and far below the 84+% now achieved by America's closest economic peers. Still, employment gains have been extremely broad-based. The share of people with disabilities with a job is at a record high, the share of working-age women with a job is 0.2% below all-time highs, and the share of 55 to 64-year-olds with a job is near a record high. For example, there are still some issues with impacting labor supply. An outsized number of workers are still getting sick and struggling with childcare, but the overall picture is that employment rates have stabilized at a level just below pre-pandemic peaks. Wage deceleration. Core wage growth, ECI, private industry wages, and salaries growth was in line with expectations. Annualized percent growth, quarter-on-quarter percent growth, annualized. Meanwhile, comprehensive data on wages and benefits from the Employment Cost Index shows wage growth decelerating significantly over the last 2 quarters. Year-on-year growth in the private sector wages fell to 5.1% in Q4, coming in below consensus expectations, while quarterly wage growth on an annualized basis grew only 4.1%. That quarterly growth rate is about as consistent with the high end of normal wage growth levels that U.S. recorded during the strong labor markets of the 1980s and late 1990s, though obviously conclusions cannot be drawn from one data print alone. Is the labor shortage ending? Wage growth looks to be decelerating now. Wages Employment Cost Index, private composition adjusted, average hourly earnings, private not composition adjusted. Recent movements in the more frequent average hourly earning prints also suggest more wage disinflation could be on the way, although these numbers are much more volatile and have been subject to extremely large revisions recently. However, the pace of nominal wage growth likely remains slightly too high to be consistent with target inflation. The quit rate remains elevated, and wage growth in posted job openings on Indeed was 6.2% over the last year. Conclusions. Tighter monetary policy changes financial conditions and economic planning almost immediately, but the effect of these changes can take a while to show up in broader economic activity data. So far, the labor market has withstood a tremendous amount of rate hikes without the amount of contraction expected by policymaker, markets, or most economists ex ante, and in many ways, the disinflation we've experienced amidst labor market strength has been a relatively ideal outcome. Chair Powell and the FOMC acknowledged the start of that disinflationary process at their meeting this week, stressing simultaneously that they know lags in the transmission of monetary policy mean much of their prior tightening hasn't yet shown up in economic data, and that they still don't believe they have done enough to contain inflation yet. As talks shift from the pace of rate hikes to the level of terminal rates, labor market data should nudge the Fed to believe that they are making progress on their disinflationary goals, that underlying economic growth is stronger than previously thought, and that a soft landing is now marginally more likely. Relatively descriptive article. I like it. That was a good primer for this article. This article, which makes the claim that workers are enjoying the tightest labor market in decades. Let's read this and see if we come to similar conclusions. This is by Timothy B. Lee. The latest job numbers suggest there is no recession in sight. A little bit more, let's say, optimistic, this article, and certainly the framing of it is more optimistic. So let's read it. The U.S. economy gained 517,000 jobs in January, crushing economists' expectations. The unemployment rate fell to 3.4%, the lowest figure since 1953. In short, the labor market continues to defy economists' predictions that we're likely to have a recession in 2023. Economists have been anticipating a recession because the Federal Reserve has been aggressively raising interest rates over the last year in an effort to bring down inflation. On Wednesday, the Fed raised rates another 0.25% and signaled that more rate hikes were likely in the future. The campaign against inflation seems to be working. Last month, the Bureau of Labor Statistics announced that prices rose 6.5% in the year ending December 2022. That's the lowest inflation rate in more than a year, though it's still well above the Fed's 2% inflation target. Big rate hikes often lead to job losses, and in the second half of 2022, the labor market really did seem to be softening. The pace of growth, the pace of job growth steadily declined between July and December. However, even December's job growth figure was above the long-term average, and January's gain of 517,000 was far above historical norms, suggesting that the job market is still getting tighter even as the Fed raises interest rates. The payroll data shows no signs of a recession. Monthly change in non-farm payrolls in the thousands, average growth from 2010 to 2020. And you can see, I suppose, that the 2020 numbers are all, essentially all, except for December of 2020, for one reason or another, outpacing the average growth of the 2010s, I suppose. Let's see. Indeed, I think the chart above actually understates how impressive that 517,000 job figure is. The economy gained about 600,000 jobs per month on average over the course of 2021. The last month's job growth doesn't look that unusual when you compare it to the previous couple of years. But we have to remember that the job gains of 2021 came shortly after employers laid off a historically unprecedented 22 million people between February and April of 2020. Indeed, I started this chart in October 2020 because otherwise the huge labor market swings between February and September would make the rest of the chart unreadable. A lot of that 2021 hiring was employers staffing back up to normal levels as the economy reopened. But we're now 3 years past the start of the pandemic. Job growth today is mostly not pandemic rebound hiring. So to get a sense of just how impressive the 517,000 job figure is, it's helpful to compare it to the pre-pandemic years. Between 1990 and 2019, there was just 1 month where the economy gained more than 500,000 jobs, a $530,000 job gain in May of 2010. Even if you adjust for population, there were only 2 other months, both during the 1990s boom, when the economy added jobs at a faster pace than it did last month. Recent headlines have given a somewhat misleading impression because high interest rates have disproportionately affected the high-profile technology and media sectors. There have been a lot of articles about layoffs in Silicon Valley, and that's reflected in data showing that the information sector lost 10,000 jobs on net between November 2022 and January 23. But these layoffs have been dwarfed by robust hiring in the leisure and hospitality sector, which gained 192,000 jobs between November and January, and healthcare up 111,000 jobs over 2 months. Here's another way to look at the health of the job market. Prime age employment is near pre-pandemic highs, and this was the same data referenced in the previous article, 80.2% versus 80.6% pre-pandemic, and then sort of the peak in the early 2000s of 81.9%. But then I think they mentioned that sometime in the 90s, it peaked out at 84% was the highest it's ever been, something like that. This shows the ratio of workers to a population for those working in the age of 25 to 54. This is a useful indicator because it excludes those over 55 who may be retired and those under 25 who may still be in school. By this measure, the economy hasn't quite rebounded to the January 2020 peak of 80.6%, but it is very close at 80.2%. The 0.4% difference combined with the ultra-low unemployment rate makes me think there are still a few people being kept out of the labor market due to COVID. Still, it is remarkable how quickly the economy rebounded from the April 2020 low point. It took less than 2 years for the prime age employment to population ratio to rise from less than 70% in April 2020 to 80.1% in March of 2022. In contrast, it took a full decade for this measure to rise from 74.8% in December 2009 to 80.6% in January 2020. If the recovery of the 2010s had been quite as robust as the post-COVID recovery, we would have returned to the previous peak 8 years earlier in 2011 rather than 2019. Slow wage growth isn't all bad news. The least impressive part of today's job data is wages. According to the Bureau of Labor Statistics, average wages rose by 0.3% between December and January and by 4.4% over the last year. With the inflation rate well above 4.4%, this means most workers' real wages have actually been falling. That's not great news, but there are a few silver linings. One is that wages are likely to be a lagging indicator. It takes a while for employees to notice that they have bargaining power, demand higher wages, and for the resulting raises to go into effect. But if inflation continues to fall while the labor market stays strong, as seems increasingly likely, we may have the opposite process occur over the next couple of years. Inflation may fall back down to the Fed's 2% target, while wages continue to grow at a faster pace. We're also continuing to see a decline in wage inequality. Low-income workers are getting the biggest wage gains, median hourly wage growth by income quartile 3-month average. The top 25% versus the bottom 25%. I suppose certainly you can see that the bottom 25% is growing more. This is based on Atlanta Federal Reserve Wage Growth Tracker. Tight labor markets are good for all workers, but they tend to be best for workers at the bottom end of the wage scale. The economic boom of the 1990s produced strong wage growth for low-paid workers, while the recessionary periods of the early 2000s and the early 2010s saw low-wage workers falling further behind highly compensated workers. Since 2015, for low-wage workers have once again been exceeding those higher up on the income scale, and the pandemic seems to have widened the gap. As a result, the workers at the bottom end of the income distribution have seen their wages almost keep pace with inflation over the last 2 years, while higher-paid workers have seen their wages fall significantly behind. A final upside of a slow wage growth is that it should make the Federal Reserve feel more comfortable ending its campaign of rate hikes in the coming months. The Fed's nightmare is a wage price spiral where employees start expecting big raises to offset anticipated inflation, and employers automatically pass that cost on to consumers. If this feedback loop becomes entrenched, as it did in the 1970s, it could become much harder to bring down the inflation rate. But the latest jobs report continues to show no signs of that happening. Wages are lagging behind inflation, they aren't driving it. That should give Fed officials more confidence that inflation will continue coming down even if they bring their rate hikes to an end, which makes it less likely they'll tighten too much and bring about the recession economists keep warning about. Overall, a couple of pretty good articles that detail what's going on in the labor market today. I think that was pretty informative. Overall, it seems like it's still a pretty tight labor market. You're still having, especially low-wage workers, have a relatively positive negotiating position compared to previous workers in similar income circumstances. And so it's good insofar as what some people are going to ask, which is, how much is this due to policy? I mean, I think a decent amount of it is due to probably government policy, right? So, the infrastructure bill and the IRA and stuff like that, additional investment in key sectors, things like chip making and stuff are going to have, impacts on whether or not this employment numbers come in good or not, because more spending is going to result in probably more hiring in certain sectors. So I don't think that that's a coincidence. But overall, I would say that this is mostly just a sign of recovery in several key sectors as a result of the lockdowns and sort of pandemic-induced recession in the early 2020. So, but overall, I'm a good Democrat, so I'll just give all the credit to Joe Biden. But that was a pretty good couple of articles explaining kind of what's going on in the labor market, kind of what's going on in the context of this last pretty good jobs report. So there you go. Last night, I heard a conservative on the talk radio say that the recent jobs report is only good because of businesses expanding for the holidays. Is that true or not? So that is not true, because jobs reports are seasonally adjusted. So if you see spikes in employment around holidays because, people are hiring more workers to deal with holiday shopping, that is taken into account when it comes to these jobs reports. So what he is saying is not true, and it is a misunderstanding of how these statistics are collected. Also, could you explain the relationship between interest rates and the labor market? Well, the idea is just that if you raise interest rates, you're increasing the cost of investing. And if you increase the cost of investing, then obviously corporations aren't going to invest as much. And if they don't invest as much, that means they're not going to hire as much, right? And so if they don't hire as much, you'll see depressions in sort of labor growth, and you'll see potentially unemployment going up. So isn't this kind of counterproductive? Wouldn't job growth just keep boosting inflation? Well, that's kind of the balance that the Fed is attempting to strike, right? Is that if you have a very, very tight labor market, then potentially wage inflation causes aggregate increases in inflation. Now, I think that presently what that article demonstrated and what many other articles have demonstrated is that that isn't really what's happening currently. So currently nominal wage growth is pretty good, but it's not enough aggregately to keep up with inflation except for lower income workers. Lower income workers seem to be doing actually pretty well during this inflationary period in terms of their wage growth, but that's not enough to really cause incredible increases in aggregate inflation because everyone else's wages aren't really keeping up, like these higher income workers, right? So, it's the answer to that is yes and no, right? But overall, that's something that the Fed is looking at and something that people are sort of commentating about, but there's not great evidence that the tight labor market is really significantly contributing to inflation. So that's it, guys. Good update on the jobs situation I believe that's what I think it's the employment situation that how the BLS labels it. So hope you guys enjoyed that one.